From Impact Alpha, it's This Week in Impact, where we bring you some of the most interesting impact investing and sustainable finance stories of the week. I'm Brian Walsh, and this week I'm joined by Impact Alpha editor David Bank. We'll discuss how some impact investors are responding to the growing political risk in the U.S. market. Plus, how in a polarized U.S. Capitol, the idea of employee ownership brings lawmakers together. And finally, how a volatile market is leading some restive LPs to look to secondaries and creative exits to recoup their capital. That's all coming up on This Week in Impact. Hi, David. I hope you're having a great and not just a good Friday.
It is a good Friday, Brian, and it's because I'm back home after 2 weeks on the road, so it feels really nice to look forward to the weekend.
Yeah, you had a whirlwind trip, and I understand that you are now an award-winning filmmaker. Tell me about that.
Thank you. Yes, we capped this road show off with the Boston International Film Festival, where we won a Best Documentary Award for our mini documentary, Equity and Ownership.
All right, well, congratulations. Very excited about that. All right, now turning to our top story, David, we see increasingly worrying signs of political risk in the U.S., with the Trump administration going after major institutions across society, from law firms to media companies to universities to the currently independent Federal Reserve, with indications that this gathering storm will soon head towards foundations, nonprofits, and even private investment funds. Now, this week, David, you were at a convening of impact investors, the West Coast Forum of the Global Impact Investing Network, or GIN. What did you hear about how impact investors are preparing for this expected scrutiny that's likely to come their way?
Well, it's interesting, Brian, because there was, the usual, I would say, but, work goes on, as we've said, and there were panels, on regenerative agriculture and affordable housing. And in fact, people were, very excited about their strategies. And some fund managers said that they had been having fundraising success, against all odds and against maybe the prevailing winds. But there was both a backdrop and then increasingly actually outspoken recognition of this kind of moment that we're in. And as you said, political risk is becoming a thing in the U.S. It was something, people thought about, obviously, in volatile other markets, but now we're the volatile market. And in particular, Don Chen of the Surdna Foundation made a very forceful kind of call to action to the assembled. Let's give him a listen.
My message to you is this. Let's not give in to these baseless attacks. We know the evidence. We know it generates excellent financial returns. We know that considering external factors helps us manage systemic risk. And we know how to make socially beneficial investments to foster a more just and sustainable world. But more important than all of that, we're an American foundation. I know most of you are from the U.S., some of you from outside the U.S. I would say as Americans, we all enjoy freedoms that have long been a model for the world. For us as a private endowed family foundation, that means we have the freedom to make decisions about our investments and grants. We have the freedom to ensure that our dollars deliver a double bottom line, or sometimes even a triple bottom line. And we have the freedom to reap the benefits and also to make mistakes and learn along the way. These are fundamental rights that we cherish, and we should be all prepared to defend them so that, and I'm going to quote the GIN's mission statement here, so that investors deploy capital both for financial gains and positive impact for all people and the planet. That's worth fighting for. Thank you.
All right, so David, that's a pretty powerful defense of the Surdna Foundation. How was it received in the room?
People, I think, resonated to that. I mean, I think there's a sense that some leadership is called for. Don had a letter out about a week ago about their continued commitment and a call for solidarity. So this is not out of line for him, but he is stepping forward in a time when others maybe are stepping back. And I think the sense is that foundations are definitely in the firing line. There's been obviously efforts to go after universities, as we've seen, and law firms, of course, and many other institutions, and foundations are bracing for their turn in the frying pan. But this was really a call about investment. This was really a call about the freedom to invest. And I think that's becoming a rallying cry or something that folks can rally around, which is, it's if it's your money, you can invest it in the way that you like, consistent with the law. And I think people appreciated, somebody standing up and just saying that.
Is there any indication that other impact investors are going to come under the microscope or the firing line, as you put it?
Well, I think they can come at it. The nonprofits are on the nonprofit status. That's probably the first to go. There have been efforts, of course, already, around attacks on grant programs and other things that take into account, DEI or have racial preferences or racial targets. I would say everybody's kind of rapidly, scrubbing that kind of language and trying to get in line on that sort of thing. But to go after private investors, investing their own capital, I think would be another bridge that would be crossed. And Lauren Booker Allen of Jordan Park Group out here in the Bay Area kind of seconded the call. Stand firm. Here she is.
Look, I think we're feeling the sentiment throughout the day. We understand that we're all operating right now in a new environment. And so we are being very thoughtful about what it is to mitigate risk in that environment, how to think about navigating challenges in that environment, and navigating opportunities in that environment. And, the reality is this is all parts of the impact sector are potentially under the radar, and there is scrutiny. And so, we want to make sure, and, maybe we get to the call to action, but this is a moment in time. This industry is going to continue to evolve, but we're in an unprecedented window, right? And so if there's ever a time to lock arms, forget what your day job is or what platform you're at, some element of do what you have to do, knowing that your group of stakeholders, Elizabeth, might look different than my group of stakeholders. I will tell you, our clients, we're not getting that pushback. I think similar to Caitlin, there is conviction. We know who we're working with. Our firm is committed to it. But we also know to protect the work that we're trying to do what you have to do. If that is being more thoughtful about language, if it's being more thoughtful about, what things you're being super public on your website versus everyone's going to have to figure that out for themselves. And I hope and agree that, time is long, and we'll see how all of this plays out. But this is not the time to step back, not have the courage, not have the conviction. And I appreciate that people are in different seats, so there could be different versions of empowerment and agency in some of this conversation, but collectively, from asset owner all the way through allocator, manager, ultimate funders or founders that are building companies for products and services, reaching these people, it's called impact investing. And if we forget about the impact or talking about it or figuring out how to protect it, why are we here?
All right, forceful words. Well, for now, let's take a quick break, and when we come back, we'll discuss how even in this polarized moment, the idea of employee ownership is bringing lawmakers from across the aisle together. For months now, ImpactAlpha has been focused on the ownership economy, and we're not the only ones. Last week, politicians from both parties came together at the U.S. Capitol for a 2-day forum on enhancing employee ownership. David, you were there with our Rudy Sonatas, who wrote about the gathering, which was co-hosted by the Aspen Institute and Rutgers University's Institute for the Study of Employee Ownership and Profit Sharing. What stood out to you about this moment?
Well, we met on Capitol Hill, and it was actually bipartisan. And people say that's dead, and this seems to be one area where maybe it's not dead. And Senator Bill Cassidy, Republican of Louisiana, came by and rallied the crowd by saying that employee ownership was like a warm embrace between Karl Marx and Adam Smith. And that, who could be against that? And that was kind of the tone of the day. There were other Republican senators and congressmen and Democrats as well, and they're kind of making common cause around finding ways to encourage companies to give workers a bigger stake in those companies. In some cases, 100% stake in the companies that they're building.
Now, in the U.S., we have the structure of the ESOP, the Employee Stock Ownership Program. There's roughly 6,500 of them in the U.S. that hold over $1.8 trillion in total assets on behalf of more than 10 million workers. So what are some of the ideas that are coming out about potential legislation to kind of encourage more ESOPs here?
Well, the biggest challenge is financing the buyout. So an ESOP essentially sells over time the shares of the company to the employees, paid for by the revenues of the company itself. So it doesn't require the employees to pay any extra to buy the shares. But the problem is that over time period. So the generally speaking, the selling owner has had to put out a note to the workers essentially to finance that time gap, and then they don't get their money out quickly, and that's a disincentive for them to make that kind of transition. So there are a variety of funds that are in a sense stepping in for the selling owner and financing that financing gap. And so there are some proposals on the Hill, and they've been bouncing around for a couple of years, but there does seem to be new support for them to help provide like government guarantees that will help bridge that financing gap. And then there's other proposals around expanding ESOPs more broadly.
Now, is there any indication that this will make its way into the tax cut legislation that's currently being negotiated?
Well, in fact, there's the opposite fear, which is that as the budget writers look for savings, that the tax breaks that ESOPs get, which are quite substantial and are also part of the incentive for doing it, could be on the chopping block as a way to make up some of the shortfall from the other tax cuts that they're considering. So obviously, it's very hard to predict exactly what's going to go on these days, but I think the point is that employee ownership does have bipartisan support, and that should stand it in good stead.
So this green shoots of bipartisan support for this compelling idea is really in contrast to the overall prevailing winds that we're seeing in our political discourse right now.
Yeah, I do think we all have to be able to kind of hold contradictory ideas in our head at the same time, and one of them is to make common cause in places where there are solutions that can benefit the lives and financial security of working people, and in particular the Sorensen Foundation and Jim Sorensen, who was at the GIN Forum this week, extolling again this very point that employee ownership is something where folks can find ways to work together.
All right, well, you can read Rudy's full story on this bipartisan effort on worker ownership on ImpactAlpha.com. There's also a link in our show notes. For now, let's take one more quick break. When we come back, we'll discuss how the current market turmoil is causing some LPs to seek creative exits to get their capital back. Trump's unleashing of a global trade war has caused major tribulations across the capital markets. 2025 was supposed to be the year when initial public offerings and mergers and acquisitions came roaring back. Instead, the instability caused by Trump's on-again, off-again tariffs have drastically slowed down both IPOs and M&As. That's prolonged an exit drought that has left private equity funds and their limited partners without needed liquidity. David, as Amy Cortese reported for us this week, capital distributions to limited partners are at an all-time low. So what are LPs doing to meet their needs for liquidity right now?
Well, LP's need for liquidity is, they want their money back. And partly they want their money back so they can deploy it into new things. And partly that, there's time value of money and things are getting long in the tooth. And sometimes these funds have had extensions and things. We quoted a line of DPI is the new IRR. So if you want your acronym lingo, distributions of paid in capital. Is the measure. So how much the GPs are sending back to their LPs, as you say. And there turns out to be like a whole raft of new and creative ways to get money back to the LPs. And that's what Amy Cortese wrote about this week.
So can you tell us about some of these kind of new ways to get money back that the GPs are kind of cooking up here?
Well, the secondaries market is hot, and this is not just an impact thing, but now it's coming to the impact world, which are funds that will buy out the stake of the earlier LPs and then take on the rest of that fund. And there's the ways to value those stakes, and so people are raising secondaries funds now to swoop in. And again, because LPs are so eager to get their money, sometimes the valuations are very attractive. There's also something called continuation vehicles, and that just allows a general partner to create a new fund, essentially to sell the stake to themselves, and then the investors in the new fund, in a sense, pay out the investors in the old fund. So there's other things, in the private credit market, and those are becoming attractive for exactly this reason. And you can do kinds of revenue-based financing and other things where the money does come back in a more sort of automatic sort of fashion. And so in some ways, credit has become easier sell now than equity, where you have to wait for the exits, which are hard to come by.
So some of these trends are, trends across LPs and GPs in general and across the private markets in general. But what's the impact here on impact investors?
Well, impact investors want their liquidity as well, and partly, again, to make investments in new funds and get new things going, and not just be sitting around waiting for the old thing to pay off. So it's not just greed; it's also can be impact, or at least strategy. North Sky Capital in Minneapolis has been in this market for a long time. I think they've just raised maybe their ninth secondary impact secondaries funds, and they buy out stakes in sustainable agriculture, health, wellness, climate, decarbonization. And the new fund has more than 24 transactions under its belt. And they also do some direct secondary deals with family offices, buy their stakes as a kind of one-off. Now there's a new outfit called Octubre, and they're kind of French, or I think Belgian. And they are raising a fund and have a pool of capital that would essentially provide kind of liquidity across funds. So a GP could tell its LPs, its prospective LPs, that there will always be someone ready to buy out their fund, and essentially that gives them a kind of liquidity that GP hadn't been able to offer before. And the notion is that can then crowd in kinds of institutional capital that needs that kind of liquidity for their own investment policy, and therefore maybe mobilize additional capital for impact.
All right, well, you can read Amy's full piece on how rest of LPs are trying to come up with creative solutions to get their money back on ImpactAlpha.com and via the link in our show notes. But for now, that's going to do it for this episode of This Week in Impact. Thank you, David.
Thanks, Brian. It's been fun.
It's been a good one. And thank you all for listening. This Week in Impact is a production of Impact Alpha and part of the Impact Alpha podcast network. Smart conversations by and for impact investing professionals. For exclusive stories and insights about the world of impact investing and sustainable finance, join thousands of other agents of impact by subscribing. Just go to impactalpha.com/subscribe for full access. Thanks, as always, to our producer extraordinaire, Isaac Silk. For David Bank, I'm Brian Walsh, Managing Director of the strategic advisory firm Human Nature. We'll see you next week for more impact.